Look, the idea was that the financials would do well this year. But we've now got a tougher regulator being nominated by the White House. You've got costs going up. Do those offset the idea that actually in a rising interest rate environment, you want to buy the banks?
Yeah, I would, of course it could, right? I would say everyone kind of knew we were going to get a harder regulator from the Fed on banks. So I don't think there's anything surprising there that's not already priced into the market. I think the natural dynamics, as you said, rising interest rate environment, banks do better. I think the, on the other side, longer duration assets like tech, where all of the value is very long term, get discounted a lot more in an environment like that. So I don't think 1 month or a couple of earnings coming out is enough to say, okay, the natural dynamics are offset here.
Dana, let's talk just a little bit about, you said that it was priced in about the market, but how much of this is also the outperformance, in these financial stocks is coming from perhaps a bet on this kind of rebound in value stocks, something that we started 2021 off expecting would thrive, and then we had that turnaround. How much of 2022 is mirroring that?
Yeah, that is a really great point. And depending on the measurement you use for value, last year, growth did still outperform value. And certainly value is doing very well for a long time. It depends on your measure, how you're investing. I would say that prices still matter, right? And we are at a point now where by certain measures, the gap between growth and value stocks on a price basis are more than what we saw in the dot-com bubble. So I do think price matters. I do think eventually, and mean reversion, right? Which is just the tendency to go back to the norm, all works in favor of cyclicals, value stocks, et cetera.
The market thus far seems to have taken like 3-4 rate hikes really calmly. I know the NASDAQ is down, we're down like 4%, but if you'd have told me a year ago that we'd be talking about 3-4 hikes and the NASDAQ would only be off its record high by that kind of amount, I think you probably would have been a little bit surprised.
Yeah, a lot has happened for sure. The Fed really changed its tack, right? We spent the year hearing the Fed talk about inflation is transitory. We care more about full employment. We're not going to preemptively act, et cetera. Now you're hearing pretty much the exact opposite in terms of the rhetoric. You're hearing hawkishness. FOMC says about 3 hikes. We know that hedging, the forward curves are saying more like 4. So we've definitely switched, where mindsets are. But let's not forget, it's a long way to go. And there's a lot of information that the Fed can take in between now and the end of this year, right? So if Omicron is not as manageable as it appears right now, if growth starts to taper off, if we have a flattening of the curve, the Fed's going to be reactive to that. They're going to pay attention to those inputs and not necessarily just keep hiking.
Dana, I'm so glad that you mentioned that the market is pricing as many as 4 rate hikes. If you actually look into the curve going out to 2024, some people are saying as much as 8 rate hikes between now and then. I'm curious, though, how much you think, say, the 10-year yield can really rally as you have these conversations been going on for months on end.
Well, we are seeing that starting, obviously, now, right? I think because Omicron looks more manageable, so folks are expecting higher growth. Obviously, we had the retail report that in December it wasn't as good as we thought, but it's one month, right? I do think that treasuries are going to continue to rally. I do think, the information I get, there's sort of a band around that, right? So do we get to 2%? And really that difference between whether we're steepening or flattening, I do think makes a difference in the Fed's movements. And it remains to be seen. Growth is going to be a big driver.
What do you think is going to happen with some of the other assets that we're watching so carefully? One of the things that I think has caught some people on the hop already so far this year has been dollar positioning. The dollar has weakened. I know it's not today, but you've still got a euro dollar at 114. You're starting to see other markets around the world maybe looking a little bit more attractive as we see maybe positioning changing around the buck.
Yeah, it was interesting last year to see such strength in the dollar, given how dovish we were, how much stimulus we were pumping in. But the reality is ex-US even more so, right? So it's all relative. I think the dollar actually probably continues to stay strong to a certain extent because other economies are behind us on the tightening. We're more hawkish at this point. But I don't expect to see the same level of strength, right, as these other economies catch up in the tightening cycle.
So it kind of sounds like you're saying that there shouldn't be this divergence necessarily in the dollar and yields that we have seen in the past couple of days. A lot of that, like I said, is going to be positioning that's coming up. But you seem to say that that's not going to happen, that the dollar still has some strength to go.
I think so. Yeah. I mean, just the overall dynamics of the situation, and short term volatility. It's hard to say what drives any of that, but I think when you're looking just out at the next 6 months to a year, as long as we remain as hawkish as we are, as long as we do embark on these rate hikes, tightening, right? The Fed is talking about using its balance sheet to also tighten. I think the dollar can continue its strength.
Dana, do you want to be fully invested right now? Do you think there are going to be opportunities this year as a result of the volatility if you've got cash on the sidelines? Are we late cycle, and how do I think about a late cycle environment in terms of managing my positions, maybe kind of taking a little bit more opportunity, maybe not just being fully invested, maybe thinking about kind of entry points and exit points?
Yeah, it's a fantastic question, because my thought is that probably a lot of people at this point are over-invested in equities relative to their risk tolerance, right? We had a bull market. You know what happens if I'm a 60-40 risk tolerance, let's say, balance, I enjoy all that appreciation in my equities, and then I have really more than I can probably tolerate losses in. So it's definitely a time to be looking at your portfolio and saying, okay, am I at the right risk levels? Do I need to moderate? I think everyone is expecting lower growth this year, probably more volatility, right? You're not 28.7%. It just, base rates alone, we're not likely to hit that. So looking at your positions and saying, okay, do I need to trim some equity exposure? It's not to say you shouldn't be in the markets, though. It's really more about being in the markets at the level that you can tolerate the loss.
Well, Dana, you just mentioned that volatility. Let's kind of bring the conversation full circle back to where we started with banks. How much of that expected volatility that we're going to see perhaps in the equity markets, even the commodity markets, or even say the bond market, is going to factor back into those trading profits for some of the big banks?
Volatility kind of begets volatility. So it's going to be interesting to see. I mean, if it does transpire that we get more volatility, I would expect it kind of builds on itself, right? So yes, banks and, obviously cyclical sectors are facing that contingency. But on the other side, we are looking at a situation where with luck, Omicron is sort of the beginning of the end of this pandemic. The reopening trade comes back for us. And we see the economy, energy industrials, et cetera, kind of coming back for us.